Hello and welcome to AI Market News by LM. Let's dive right in because we are seeing some massive headlines flashing across the board today. Bond yields hit 2007 peaks. Are we standing on the edge of a brand new economic crisis? Let's break down exactly what's happening in this explainer.
Now, what's really wild is this huge number staring right back at us, 5.18%. As seen in the prepared resources, the 30-year U.S. Treasury yield just spiked to an astounding 5.181%. I mean, that is a level we haven't witnessed since the era right before the global financial crisis. It's basically acting like a giant gravitational pull, sending shockwaves through virtually every single sector of the market right now.
Section 1. U.S. bond yield spike. Market reactions. Based on various news commentary, a massive Treasury sell-off is underway, and it's pushing those yields straight into the stratosphere. The main culprit here, deep-seated inflation fears. These concerns are heavily tied to energy shocks stemming from the ongoing conflicts in the Middle East, making investors demand much higher returns to hold on to long-term debt. So the really crucial point here is how rapidly this whole narrative just flipped on us. It wasn't long ago that the market was holding on to hopes for Federal Reserve rate cuts, right? Maybe pushing them out to 2027. But now, expectations have drastically shifted. We are currently bracing for a highly probable, like a near 100% chance of a Fed rate hike by January of next year. That is just a stunning reversal in monetary policy expectations. Section 2, equities under pressure, momentum choked off. Naturally, a shock to the bond market doesn't just stay isolated. According to the input sources, we are experiencing a broad, undeniable market slide. The Dow dropped by 0.65%, the S&P 500 fell by 0.67%, and the tech-heavy NASDAQ took the biggest hit, closing down 0.84%. As borrowing costs surge higher, it effectively chokes off that stock buying momentum and forces investors to seriously reevaluate corporate valuations. And that brings us to a critical tool for understanding investor psychology, the CNN Fear and Greed Index. What we need to understand here is that when a major index like the S&P 500 drops below its 125-day moving average, that slowing momentum acts as a glaring signal. It tells us that fear is actually beginning to take over the market, pushing greed to the sidelines as investors become increasingly skittish. Section 3, Global Currency Watch, Forex Fallout. With U.S. yields climbing, the ripple effects are totally international. Breaking down the latest FinViz data, the dominance of the U.S. dollar is crystal clear. We're seeing the EUR-USD pair dropping to 1.1588. But what's truly alarming is the USD/JPY pair pushing to a dangerously high 159.09. That kind of profound weakness in the Japanese yen against the dollar is something that inevitably triggers alarms for global policymakers. And right on cue, we are seeing those alarms manifest into serious intervention warnings. Just look at this stark quote from Japanese Finance Minister Satsuki Katayama, warning that Japan will take decisive action if needed. Furthermore, U.S. Treasury Secretary Bessent has also stepped in, publicly stating that excessive foreign exchange moves are undesirable given Japan's strong economic fundamentals. The pressure in the currency markets is immense right now. Meanwhile, across the Atlantic, the pressure is equally palpable. ECB Policy Committee member Joachim Nagel recently hinted that the European Central Bank may have to do something as early as June. They're actively trying to figure out how to counter the heavy economic headwinds and inflationary pressures stemming directly from the Middle East conflict. Section 4, Upcoming Schedule, Macro Catalysts to Watch. So, with all this volatility, what do we actually need to watch next? Based on the input sources from investing.com, here is the critical timeline we should be monitoring closely today. First, at 0:40 U.S. time, we get the MBA mortgage applications, super vital for seeing how these high yields are impacting the housing sector. Then, at 06:15 U.S. time, we have a highly anticipated speech by Fed Vice Chair for Supervision, Michael Barr. Finally, at 07:30 U.S. time, the latest crude oil inventories report drops. We really want to focus our attention on that 07:30 U.S. time crude oil inventory data. Why this matters so much right now is because these energy supply levels are intimately tied to the exact inflation fears driving our current bond market turbulence. If oil supplies look tight, energy prices remain high, keeping that upward pressure firmly locked on Treasury yields. All of this data leaves us with a profound and provocative question. Is this historic yield spike just a temporary shock driven by geopolitical noise, or are we actually witnessing the beginning of a new, higher-rate economic era for our portfolios?
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.